Hi everybody, it's me again, Dr. Emma. So in part 2 of derivative videos, you have learnt about forward and futures contract. I have shared with you that futures contracts are traded in exchange market. The traditional exchange market normally use open outcry system. I believed you have seen the above scenario in movies, right? These stations are called trading pits. These people over here are known as floor brokers. Floor brokers place trades for the public. There are also professional traders among them, and professional traders trade their own account. With the internet, electronic trading is becoming more popular for derivative trading nowadays. Do you want to be a trader? Well, there are many types of trader, for example, scalper, day trader, swing trader, and position trader. Let's see which one suits you. If you are a kind of person who enjoy lots of action, you might try to do quick move, that is buying and selling in less than an hour. Here you are called scalper. If you are a person who enjoy looking at chart, you might buy and sell security in the same day. Here you are called as day trader. If you are a relaxed person and able to trade in few weeks period, then you are swing trader. Lastly, if you are a serious person and analyze a lot, you might be a position trader as you will normally trade few times in a month. Next, let us look at the term traders use when they want to buy or sell futures and derivative contracts. Remember the mantra, buy low, sell high. When trading, we use the term long and short. A long position is the purchase of a futures contract. It means you purchase a contract to buy commodity in future. A short position is the sale of a futures contract. It means you purchase a contract to sell commodity in future. Let us say you want to buy 1 ton of chili in next 3 months and you think market price for chili would go up in that 3 months time. What position will you take? Correct. You take long position. When you enter into a contract, you would lock the chili at certain price. Therefore, when the market price for chili goes up more than your predetermined price, you are at the gain position. But what if the market price for chili goes down? It means you have to buy the chili at the predetermined price that is now higher than the one sold in market. In this case, you will obtain loss because you still need to exercise your contract. So, how can we get away from the risk? Aha! Financial has developed another instrument to mitigate the risk. The instrument is called options contract. So guys, an option is a contract that gives the holder the right but not the obligation to buy or sell an underlying asset at a pre-specified price for a specified time period. The keywords here are the right but not the obligation. It means in the case of long position for chili just now, if market does not trend the way we predicted, option contract allows you to not exercising it. There are two types of options. First, call option. It is an option that gives the purchaser the right but not the obligation to buy the underlying security from the writer of the option at a pre-specified price on or before a pre-specified date. Second, a put option. It is an option that gives the purchaser the right but not the obligation to sell the underlying security to the writer of the option at a pre-specified price on or before a pre-specified date. Let's say example. Let's say you want to buy 1 ton of cocoa powder in 3 months' time at a 10 ringgit per ton. So you want to buy. You might want to consider forward contract, and from your knowledge just now, you are going for long position. You can opt for call option, or you might consider put option. So let's say today you agree to buy the cocoa at 10,000 ringgit per ton, and you lock into this contract. After 3 months, suddenly market price decreases to 5,000 ringgit. If you enter into a forward contract with long position, you must exercise the contract. Here you obtain loss. However, if you have entered into call option, you can opt not to exercise your contract. Here you do not lose anything except the contract paper price. Well, I'm not sure why you enter into put option, because clearly you are wrong if you buy this contract. There is another contract that is gaining popularity but a bit complex. For the purpose of just understanding it, we will learn briefly about it. The contract is called swap contract. Swap means exchanging. A swap is an agreement between two parties to exchange a series of cash flow for a specific period of time at a specified interval. Two popular swap contracts are IR swap and currency swap. Interest rate swaps are contracts where one stream of future interest payments is exchanged for another based on a specified principal amount. Interest rate swaps can be fixed or floating rate in order to reduce or increase exposure to fluctuations in interest rate. If you are interested in learning deeper on derivative, you might want to check out Financial Derivative course. For now, I hope you understand derivative more after watching these videos. See you soon. Bye.